Oh, welcome into another daily editorial here on the KE Report. I am chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. And Jordan, first and foremost, I just want to get your updated thoughts on the gold price and the general gold market. The argument continues to be that gold stocks and silver are underperforming gold. But the fact of the matter, too, is that both of these areas and the underlying gold price are still trading in higher ranges. Yes, they haven't necessarily broken out to 52-week highs, but they're still in these higher ranges. Please give us your thoughts on how the general precious metals space is trading.
Well, Corey, I would say that we're still in a correction and consolidation. I mean, we're still in a correction that started really when the year began. If you look at the stocks, specifically GDX and GDXJ, they look to be in these A, B, C type corrective patterns where that you can say that at the end of last week, we finished the B up wave, and now we're going to have the C down wave. And then if we're just stepping back to September, that for the most part still looks to be a bullish consolidation because we have not corrected that much in terms of price. We have corrected quite a bit in terms of time. So that's still ongoing. So that's how I look at it. Coming into the week or at the end of last week, you had silver and the gold stocks were ready to test important levels of resistance going back more than a couple months. And for silver, it was about 1825. For GDX, it was in the 29s. And for GDXJ, it was at 42.43. So there were multiple levels in the stocks. And for silver, again, it was 1825. And so we saw a bearish candle to start the week where the sector gapped up, opened up higher, and then basically sold off aggressively, forming a red bearish candle. And then we saw a continuation on Tuesday. The silver chart looks kind of ugly. So that was a failure, and that tells us that the correction consolidation in silver and the gold stocks at large is going to continue. So there's no imminent breakout threat in the next couple weeks, at least, probably more than that. And, looking at gold, Corey, it's never a good thing when gold is the strongest part of the sector as it is now, because when that happens, that tells you that the sector's in a consolidation and correction. We know with gold and also silver to some degree that the net spec positions are fairly high. So, I mean, even if we see some lower levels in the metals, it wouldn't be a bad thing. It'd be good to see some specs get cleaned out. And as for the stocks, I mean, they're trading at fairly good levels here, but, based on the hard reversal we got to start the week, I wouldn't be surprised if we trade lower. I mean, there's still some good distance between silver and the gold stocks in their 200-day moving averages. So, I mean, we're in an uptrend. Everything's fine. There's nothing to worry about. But even within that, the downside scenario would be it's possible that silver and the gold stocks could test those 200-day moving averages. So keep that in mind.
So, Jordan, can you give us a little bit more information, too, on that whole theory of a correction, not just in price, but in terms of time, too? I've heard that a number of times from gold commentators saying that gold doesn't need to necessarily drop significantly, but even just buying some time and moving sideways in a choppy manner can help reset some of these overextended sentiment levels and other technical factors.
Well, corrections can occur in terms of price and time, or price or time. Sometimes when you get a correction, especially in a strong bull trend, corrections tend to be swift, where they're short in terms of time, but like they can happen very quickly. But it's also possible that you can get a sideways correction, which is more of a consolidation, where you don't really correct that much in terms of price, maybe a little bit. But the real correction is it goes sideways for a while. And so it's a correction more in terms of time. So the more time it goes on, the bulls might get discouraged and sell out at some point. The bears try and push it lower, but they're, not able to successfully do that. And then you have people who come in and accumulate. And so the net result is the market goes sideways for a while. And if you look at GDX and GDXJ, I mean, depending on what happens over the next month or two. But those look to be more, I know they've given some back in terms of price, but if we're looking at those from a bird's eye view, they've had a correction more in terms of time than price. So that's one example. And gold, gold did make a new high recently, but wasn't confirmed by the rest of the sector. So I mean, if gold were to, drop a little bit here to the low 1500s and maybe just kind of go sideways in a range for the next couple months, that could kind of be setting up a correction in terms of time more so than price. So that's really how I look at it. And, gold and silver going sideways for a little while longer, as you said, that could help, flush out some of the specs because look, we have to remember markets are all about supply and demand. There's buyers and sellers. And gold and silver right now, well, gold especially, yes, it did make a new high, but again, it wasn't confirmed. We know that there's a lot of specs in the market. So there's not enough, potential buying right now for gold to break out and move a lot higher. It needs more of a correction where more of the, whether it be by price or time, where more of the specs can get cleaned out and the market can kind of reset itself to more of an equilibrium between, buyers and sellers. And then that's the point when the market, eventually there's more accumulation and a little bit more speculation can push the market higher, and because of the correction, then it's more in a position to be able to sustain a move higher. And so it's not quite in that position right now.
So, Jordan, what about some of the other markets that are sometimes somewhat correlated to the precious metals, whether we're looking at, say, bonds or the U.S. dollar or even the U.S. equity markets? What do you see as having some sort of impact on the precious metals price as we move through, let's say, the next few months?
Well, what we've seen recently, Corey, which is at least in the last couple of weeks, which has helped keep gold firm is, we've seen a tiny correction so far in the S&P, and that could continue. And if that continues, that could eventually lead to a rate cut, which would be really good for gold, obviously. But more so the U.S. dollar, we've actually seen strength there where it's at a pretty good rally in the last couple of weeks. It's punched above a confluence of resistance in the mid to low 97. So it's been able to rally above those levels. And, a stronger dollar, that's also pushing bonds higher and yields lower. And so we talked about that, I think, last week, how lower yields is obviously bullish for precious metals because the more that continues, remember, the Fed follows the market. So the more that continues, the lower yields go. That could force the Fed's hand to resume its rate cuts. So these things that are happening, they are helping support gold, but they're not quite at the level where gold is ready to break out. You could say it probably requires a little bit of time. And Corey, if we get a strong dollar that persists, if these lower yields really persist or go even lower, again, these things could take some time. That could push the market to a belief that the Fed is definitely or strongly likely to cut rates. And so it takes some time for us to get to those points. But if the market gets to those points and you throw in an S&P that maybe corrects 10% or whatever, you throw all that in where a rate cut seems certain, that's the catalyst for, gold and then perhaps the gold stocks as well, breaking higher and, having the potential to really run higher. And so where we are here and now, both fundamentally and technically, we're not quite there yet. So again, it'll require more time for the fundamentals to play out, and also more time technically for the market to correct, whether it be by price or time, and get in that position where it has the ability to rise and sustain a rebound or a rise.
Okay, and you know what? You and I are recording this just before the Fed meeting, so we don't know what's going to come out of Powell at the press conference or even the Fed statement, but I don't think anyone is expecting anything too drastic. But hey, maybe later on down the road when the Fed is forced to cut rates, yes, that is still a driver for gold. Remember, that's what I think really helped gold break out in just the last years when the Fed switched course. Let's just quickly talk about the stocks too, because in your newsletter you do cover a lot of juniors and some of the mid tiers, but when it comes to some of the juniors, no doubt that they have been lagging. However, there continue to be the odd standout. You need to be very selective. How are you being selective in terms of selecting your juniors?
Well, Corey, to really find the standouts, I think to boil it down, I mean, I have criteria that I follow, but to boil it down and make it as simple as possible, if you're looking at producers, let's talk about junior producers. It's all about production growth. You want to find the producers that have production growth and have the potential to grow their production over the years ahead. So that, I mean, that's critical. And one thing that I realized, I mean, this is not rocket science, but producers, obviously a higher gold price helps. That could expand your margins in production growth. I mean, that helps as well. But exploration success is a real wild card. And we've seen, several companies do extremely well. Several producers do extremely well because of exploration success. So a producer that has exploration success that can give it more production growth, I mean, that's huge. And also when a company has this exploration success and it beefs up their potential production growth over the coming years, they're going to trade at a stronger valuation than if they didn't have that production growth. So that's really what I would look for. With producers, it's all about production growth and also exploration success for an existing producer. That's huge. We've seen that really benefit a number of companies. And also in terms of the same thing, growth. If you're looking at junior exploration companies, I'm also looking for growth in terms of, do you have a discovery or an existing resource that has growth potential? Do you already have something, and is this something that you could grow, double or triple or grow 5 times what it is? That is also what I'm looking for in terms of exploration. For the most part, I don't want to be in things that are more mature and getting into that development stage, unless they're just like dirt cheap, and they have tremendous optionality. I'm pretty much ignoring those. It's all about growth. For producers, you want to find production growth. If you're looking at explorers, how much can they grow a discovery that they've already made? Or how much can they grow an existing resource? The market loves growth, and so I'm trying to find it, whether it be in producers or explorers trying to grow their resource.
Okay, hey, fair enough. And you know what? The market does like near-term growth too, right? And that's why I keep on trying to find these companies that have some sort of an exploration program where they are putting money into more discovery holes rather than simply, let's say, de-risking a project, which is also important. But yeah, in terms of share price moves, the market does want to see growth when it comes to resources and when it comes to production. Jordan, thanks for chatting this week. I look forward to chatting with you next week. And there's not much more to say when it comes to the precious metals sector. Maybe just a little bit of time is needed for another breakout.